They'll fly at her. Good morning, everyone. We're looking forward to meeting today with David Atkins. I go back to our mission statement, and that says we improve lives. And part of improving your lives, I believe, is to address what's going on in the markets right now. There's quite a bit of uncertainty with respect to the Russian invasion of the Ukraine, what's going on in the markets around that. And I thought, what a great opportunity to bring in David Atkins and talk about that. David is a dear friend, one of the partners at Value Partners, portfolio manager with decades of experience. He's been through this. He's been through other situations like this. And currently right now, to put things in perspective, David runs about or manages about $1.8 billion for Value Partners investments. He takes that responsibility very, very seriously. We love his logic, and you will find, as David speaks, a lot of what we talk about with respect to logic and investments is very much aligned with David. And I sure appreciate everything he's done, sharing his communications with us. We thought we can improve your lives by sharing communications directly with you about the process and the decisions being made behind the scene. But one thing I want to start with really quickly here is, David, we have a philosophy here at Abbott of alignment of interest. So we want to own what our clients own in the portfolios. There's not something for us and something else for the client. Can you maybe start by explaining that culture at Value Partners itself?
Right. No, I think it's so important that we invest our own money alongside clients, and we mean that. And when I say that my money is invested alongside yours, all of my investments are in this particular pool, actually. So it's a meaningful thing, I think, to be so confident that what you're doing for your clients is right. You're doing it for yourself.
Right. Thank you. Thank you so much. Well, David, I would love to hand this over to you now. And just so you all know, we've been fielding a few questions from clients. So I compiled those questions and sent them to David to give him a little bit of time to think about that and how his experience plays into those questions. So David, if you could just take it away, if you like.
All right. You can see my screen okay?
Yeah. Perfect. Yes.
All right. Okay, so that's me. So one of the questions was, are there periods in your experience that are similar to what we were going through presently? And, every situation is always a little different. But what is so similar about this situation with the invasion, unfortunately, from Russia into Ukraine, there's a number of examples over time where events have caused market uncertainty. And that's really sort of the theme that I see over and over and over again, is that some event causes people to be concerned. The uncertainty causes the markets to come down. People sell first and ask questions later. So there's lots of situations where the markets have endured presidential assassinations, world wars, the financial crisis. You look at the pandemic that we've just gone through. But I think the takeaway is that the markets get through this. These businesses that we own have been around in some cases for over 100 years. So think of all the environments that they've had to endure. So you have to stay focused on owning the right businesses and understanding that over time, economic growth happens, the businesses grow, and these events actually create opportunities for guys like me, because people get worried about one particular factor. Right now, everyone's worried about the war in Europe and how far is this going to escalate? And that's the uncertainty. And that creates that market downturn environment that allows us actually to take the advantage of building ownership in businesses at prices that weren't necessarily available 2 months ago. So these are actually periods of opportunity for us. I know it doesn't feel that way. I know it feels emotionally unsettling. That's typically the best time to invest.
I remember, David, back in 2008 in the financial crisis and the fear that was going through the market. You've got it listed as Lehman Brothers,
Yeah.
09-15 and a negative 46%. Maybe comment on the next 2 years. The initial was about fear, and then what happened next?
Right. So, it's back then, people always extrapolate a negative piece of information and just sort of extrapolate it even more negative, more negative, more negative. So back when the financial crisis was occurring, hedge funds were failing, Lehman Brothers failed, a bunch of very dominant US banks failed. So those are real situations. But people were starting to think, well, obviously capitalism is going to fail and none of this is going to work. So it was almost absolute despair. And it's never as bad as people can imagine. And you just have to stay the course, make sure that you're making the right decisions that are prudent, logical, understand the risks that are there, but understand that, the markets do recover, that this too shall pass. And if you give it time, then all of a sudden people start to become optimistic. But it's funny because since the financial crisis, I still say this is one of the longest, most pessimistic bull markets I've seen, just because the markets have moved higher and everyone's still worried about something all the time, it seems. But it's never as bad as what people can imagine.
They remember burning their finger on the wood stove, and that memory is deep. But I guess,
Right.
The message here, if you look at 1 year later, 2 years later at 68 and 95%, the people who were logical through the situation, did very well following that.
Right. And that's that aspect where the best time to invest is when everyone else is fearful, when everyone else is feeling like the market isn't for them. And maybe I'm just going to sit on cash. Typically, those are the best times to invest. And then on the flip side, you get those periods of euphoria, like the tech bubble, where everyone wanted to invest and everyone thought you should own these tech companies and you could do no wrong. They didn't understand the risks they were taking at that point in time when everyone else was feeling so good. So you just have to understand the emotional aspect. Do your homework, make sure you know what you're doing when it comes to the investment side of it. Make sure you own a great business, make sure you pay a reasonable price, and it'll keep you out of the trouble. But the emotional aspect is significant, and it's never going to go away. But I don't mind the volatility. Like I said, the volatility allows me to build ownership when everyone else is pessimistic. And I can actually trim the positions and take that capital and put it somewhere else when everyone else is really excited about the thing, a business or the market.
I think the power of your investment discipline, David, we talk about if you own pure speculation and you didn't have investments with true intrinsic value and they go down, you should be worried.
Right.
But when, as you just said here, when you own great businesses with true intrinsic value, you look to opt for opportunities to build positions. So
absolutely.
Yeah.
Okay, so
next question.
All right. So can you explain the importance of being calm and using logic and principles of investing during times like this? So this is what you're alluding to. So when you think about what works over the long term, for us, we've designed the investment principles for opportunity, but also for the periods of uncertainty. Because if you own a fabulous business, one you can't live without, replicate, difficult to compete with, like those businesses can endure the periods of uncertainty, whatever those uncertainties may be, better than a business that doesn't have earnings, has a weak balance sheet, doesn't have the financial capacity to succeed. So let's focus on the best businesses. And that just puts the probabilities in our favor that those businesses are going to be around for the next 10, 20, 30, 40 years. And then that price aspect. If you don't pay attention to the price you're paying to be an owner of that business, you can make mistakes. Once again, during the tech bubble, and that's where people went wrong. They might have bought some really interesting companies, but they just paid way too much, even though those businesses were successful and grew their earnings in a lot of cases. People are still losing money on that particular purchase because they just paid too much. So if you think of how do you provide a margin of safety for periods of uncertainty, just own a really good business that has earnings, that has a strong balance sheet, that's paying you dividends in the meantime, and be reasonable about the price you pay. And in both cases, that gives you that margin of safety. just in case the markets go down, just in case there's a period of turmoil or uncertainty, because there always will be. So those principles really keeps us out of trouble, but it also steers us into what is typically the best long-term options to create wealth for people. So when you look at the environment we're going through right now with this Russian invasion, how do those investment principles play out? And what is the situation now? Well, if you own a European business, there's a lot of risk there because they need energy, and it's really uncertain where they're going to be getting their energy from going forward. People are not sure how far this war will escalate into that area. But when you look at the businesses that we own, 70% of the revenues are North American based. That's by design, because I feel there's less risk. I feel there's less risk at home. There's fabulous businesses here in North America. You don't need to speculate across the world and own a business that you don't know as well or can't understand as well as the ones we own here. So it really minimizes the geopolitical risks, and we're benefiting from that period right now. Understand supply chains. The supply chain problems are just continuing because of this invasion, but these supply chain issues have been occurring throughout the pandemic because of labor, because of government shutdowns. So supply chain issues are not just recent situations. This has been going on for 2 years. So you just need to make sure you own businesses that have very good supply chain, that have flexibility in their supply chain. Well, we own better businesses, so our businesses are doing just fine. And then, rising inflation is going to be one of the factors that is going to continue because of this situation. Wars cause higher prices, causes supply chain issues. It causes a lot of issues for businesses across the board. So we own really good businesses that have pricing power. So if there isn't a period of inflation, once again, those investment principles have just led us to businesses that can weather these storms and the market uncertainties better than others. And when you pay attention to the price you pay, the downside risk from a valuation perspective, in my mind, is pretty low for the VPI Canadian equity pool today, because we're consciously making sure that we're not taking a lot of valuation risk. So once again, those investment principles just really allows us to minimize the downside risks while still being positioned to benefit from the opportunities that are available. And when you look at what the market experience has been most recently, when you look at how has the pool done since the TSX peaked back in November, and fine, we're kind of trading water up 1 or 2%, and the market is not bad in Canada because energy stocks have been doing extremely well and material stocks have been doing extremely well. So overall, not a big change. But when you compare that to what's going on in the US, once again, we're just sort of protecting capital, which is such an important aspect of creating wealth for clients in a period where the markets are going down because of high valuations, because of the situations that some of those businesses are dealing with overseas. And once again, since the NASDAQ peaked in November, the NASDAQ is down over 17%, and we're still showing capital preservation. So these are the proof pieces that the investment principles, they work in periods of opportunity, but they also work to protect capital when there's uncertainty. So I think it's just so important. I think sometimes people forget that when the markets are moving higher, things are getting riskier, not safer. and when things are going down, there's actually more opportunity. So that we're paying attention to both sides.
Well, David, looking at this chart on behalf of myself, and I know everyone on this call, as well as our clients, thank you for doing a great job preserving capital there. That's incredible.
We're trying our best.
Yeah.
And then there are typically long-term effects caused by military conflict. So what I wanted to do is just give perspective, because it really depends on where the war is and who's involved. And right now it is Russia and Ukraine. So you need to just put this all in perspective, because I understand the Russian invasion, it's tragic, but the direct impacts on the North American economy is actually quite minimal, because Ukraine's GDP is less than 1% of the United States GDP. And what I did here was I just showed Ukraine's GDP on the bottom of the chart in context of some other business revenues.
Wow.
Like I understand this is tragic. This is horrible. No one wants to see this happening. But from an investment standpoint, from an economic standpoint, this is still a small piece of what's going on right now. So just keep that in context. And then I do believe that the risks of, at the end of this movie, when you look at everything, I think the risks really are just higher inflation. I think that the supply chain issues, the situation, is just going to lead to higher prices around the world. And we were already seeing that because of the pandemic. We were already seeing that because of the supply chain problems that were occurring, the protectionism that was occurring for years before this event across the world. The money supply increase was massive during the pandemic to keep the economy going and stimulate the economy. Well, there's consequences to that, and that's inflation. So this whole trend of increasing inflation, which we haven't really seen for decades, is actually accelerating, not decreasing still. So how are you investing through this type of environment where inflation is as high as it is? You don't want to sit on cash. Cash is the worst place to be because your purchasing power is being eroded significantly. So you need to own assets. Now, we believe you should own producing assets, assets that actually can produce a cash flow that gives it some intrinsic value. And the businesses that we own within the BPI Canadian Equity Pool also pay dividends, and we expect them to grow those dividends over time. So these businesses have pricing power. They can pass off the higher input costs, their costs, to consumers. So from a business perspective, they're doing everything they need to do to maintain their earnings and grow their earnings. And then from an investment standpoint, they're paying those dividends and growing dividends over time. So they're increasing the client's cash flow, which is so important. So we focus on these businesses for reasons. It's so important to understand why you want to own a business is to extract cash flow from it through dividends eventually and through growing dividends. And our businesses are doing that. So I think that in this environment where you have such significant inflation, Canadian Equity Pool is a great place to have that capital. And like I said, you really have to think about the risk you're taking by even just having cash. It's a different time right now.
Well, it's interesting. We love the dividend growth, David, and the growth of those companies. But, you step back and you look at the word inflation, to increase in value. And, if something is worth nothing and it increases 10%, it's still worth nothing. But when you own companies with great intrinsic value,
right,
and we have inflation, the value of the company grows. So this is a great position to be in an inflationary environment for sure.
Absolutely. So what positioning are you presently taking with your investment decisions in this environment? And remember those investment principles we have. We're focusing on the long term. Let's own the best businesses over the long term, because we know that there's going to be short-term uncertainties, whether or not it's inflation or rising interest rates or slower growth or perhaps a recession or an inverted yield curve, all of the things you need to think about. But at the end of the day, I'm not really having to make any changes right now because we've already done the homework before. So when you look at where the pool is positioned today, right now we're about 43% Canada and 47% US. So we're allocating capital to the businesses that we think are going to provide the best opportunities over the next 5 to 10 years. And that's where those opportunities are. And we have $130 million of cash right now. Most of it's sitting in Canadian currency. And that cash, like I said, I don't like sitting on cash. I want to get that capital working because I know that cash is being eroded because of inflation. But I don't want to buy an okay company at an okay price. I want a great business at a great price. And those opportunities are going to present themselves. And when they do, we have the cash to be able to take advantage of it. And we will do that. And we did that during the pandemic. We moved the cash position from over 24% back in 2018 to under 2% at the lowest of the pandemic, because those opportunities from an investment standpoint were so good. And we're looking for that again. So I know you guys are rooting for the markets to move higher. I'm rooting for the markets to go lower so I can get that cash invested. But overall, this is what the pool has looked like now for some time. And the businesses we own, I like these businesses. These are businesses that have substantial earnings, that have the ability to grow those earnings. I like these businesses because they're paying us dividends and going to grow those dividends over time. So, these are, better businesses than what you find in the marketplace. And yet we pay less in terms of the value that we have to pay to own those businesses. It's remarkable to me that you can own better businesses and pay less to own those businesses, but they're there. You just have to make sure you're looking, making sure that you understand the businesses, do your homework, and make sure you pay a reasonable price. So overall, right now, I'm just looking for opportunities to either add to the businesses and build ownership in the businesses we have, or look for some new businesses where their stock prices are coming down to the point where the price makes sense again.
Well, I think there's an important point to be made here. You're sitting on $130 million of cash in the pool. A lot of our clients ask us, say, okay, we've got our money invested. We're drawing an income off of it. How are we taking advantage of the current situation and buying more positions? And I think the point being made that number one, when things get expensive, you trim positions to create cash opportunities. But also, I think the importance of owning dividend paying companies and having those dividends flow into the pool. So,
absolutely,
even though you may be drawing income from your portfolio, there's still opportunity through times like these that you are acting every single day on behalf of our clients, looking for those great companies at a great price. So,
absolutely.
I get that question a lot. So I think that really clears that up for our clients.
No, it's good. You always keep reminding me how long I've been doing this for. But
you like that, decades?
With decades. Oh, hold on.
I'm going to interlude while David deals with us here. Talk about dedication. His wife is on the sofa expecting today. And when we first started talking, he said, I'm happy I made it today. So if he jumps up and runs out of the room, we know what's going on.
Exactly. Yeah, no. So, like with decades of experience, what final words of wisdom do you have for clients? I think what's important to know, and I've been dealing with clients face to face, and I understand this is emotional for them, and they see things on a shorter term time frame than I do. But when you look at the performance of what we're doing, you see volatility. You see some years are green, some years are red. There's no predictability. It's really hard. I can't even tell you how 2022 will turn out, because that's too short term of a time frame. But what we do know is that it's more predictable over the long term, that this is a long-term investment process, that this process works, that we've been able to turn $1 million to over $3.2 million since inception. And it is a long-term process. I know everyone likes to get rich quick. I'm trying to get rich over time with certainty. And I really do believe that the investment principles allows us to do that.
Well, we appreciate the long-term returns you're providing, David. And what a lot of people don't realize is by using those principles, you are dramatically reducing risk. I saw the portfolio right now at 13.1 times earnings. So, just that fact alone, that you own these dominant companies and that price earnings ratio really shows that you're taking your time, choosing those great companies and paying a good price for them.
Right.
So that's good. Well, David, I really want to thank you for everything you're doing, for taking the time. You're busy in the investment world, but you're also busy in the dad world today. So we really want to say thank you. I think another thing we have to say is that we're all praying for the Ukraine. We're all praying for this to end quickly. I also want to thank Amy. Amy is running the technical aspect and getting this produced. And and is going to be working to get this out to our clients on all of our behalfs. And here he is, John Van Limbeck, who has just come over to Harbourfront with us. We've done some press releases and out to our clients. John was gracious enough to stay with our other dealer for a while to make sure our clients were serviced and his clients were serviced. But just recently he's come over now and he's rejoined the team on Harbourfront. So John, with that, I'd sure love it if you could thank David for his time today.
You bet. Yeah, I'm glad to be back in the saddle again. So it was a short, long period, that's for sure. Anyway, thanks, David, for taking the time. I mean, that gives us a lot of context for sure. You know, putting a couple different things together, where things are at now, how you look at things, which really hasn't changed from an investment point of view over your decades, but it always seems different. So it's always great to hear, you know, the person making the decisions, what they're going through and stuff like that too. So thank you very much on that. Great to be back. And if you have any questions, by all means, reach out to any of our team and we're here. Thank you.
Now I got to finish with one other question, David, and I always do this. How's your mom's investments doing?
Well, I know they're doing okay because she still calls me. So, it's, you know, this is where, you know, my mom's mid-70s with MS, and this is where her money is. And, you know, it took her a long time to get that trust and the comfort. But, you know, considering the decades that she's weathered through, she understands how well it works. So she doesn't lose sleep at night anymore. So that's the goal for everybody. So yeah, no, she's doing fine. I'm doing fine. So
yeah.
Well, I'll tell you. Well, she's going to have a new grandson here real soon. That's pretty exciting.
Yeah,
but
yeah.
It also, David, I ask you that question every time because I think it's hugely important to know that our clients, their money is invested alongside one of the most important people in your lives, your own mother.
Absolutely.
So, and I go to sleep at night knowing that. So that's all great. So
no, it's good. Yeah.
Thank you.
Keeps me on my toes, right?
Exactly. Yeah.
Well, you have a great day.
Thank you, guys.
Thanks
Thanks,
guys.
David. Bye all.